Okay, that's taken care of. Um, okay, so we built a new model, very different from what we usually do. It's an SPX model, so an index. We thought we'd go over some of the challenges that we had, some input factors, some fun facts that we thought were interesting, and also obviously how to use the model to your
Yeah,
advantage.
yeah, and particularly stuff to like keep an eye on or remember, since it is quite different from the Bitcoin risk model, for example.
But just before we do that, in case you're not familiar with our risk models, we are AlphaSquared, and this is what we do. We love building models that help you invest better. You can do dynamic dollar cost averaging, where you adjust your amount invested each month, week by market risk. The lower risk is, the better time it is to invest more. And inversely, the higher risk goes, the less you should be investing. You can also choose to exit. This is very clear when we look at our flagship model, the Bitcoin model, where you have clear cycles of under and overvaluation. It becomes less obvious when you look at models like the SPX, where really it's just a number go up with some volatility in between. But I think we'll talk more about that, especially Axel. We'll
Hmm.
have interesting stuff to tell. But that's essentially the models that we do and how they work and how you can use them.
So, I mean, we haven't done any introductory videos for our other models because, well, a large part of them were self-explanatory, but this one is a bit different. It was very challenging to build it. Our original sort of roadmap that we promised you guys was like mid-late April. So sorry about that. It didn't work out, but now it's finally here. And well, why was it challenging? It was challenging because, well, like you said, building a risk model for the stock market long term is hard because the stock market is not risky long term, more or less. It goes up, doesn't have the sort of fractional nature that crypto and Bitcoin has. It's a very safe haven investment historically, not very volatile at all. It was, of course, a blessing to work with a lot more data, like a lot more data. This goes back to all the way back to 1950, 1960. So you'd think it'd be easier, but it sort of wasn't. Yeah, I think the good part about this model is that since we had so much data, and from what we can tell in testing, it will generalize very well. It will not have the same challenge of like train test splits that the Bitcoin and ETH model has because it has less data. So I feel, in a sense, I feel more confident in this model because, yeah, I'm very confident it will generalize well to whatever happens in the future. We have, bubble data. So we have bubble data, plenty of recessions, plenty of bull markets, pandemics. So that actually felt good.
Yeah, pretty much.
Um,
Though you have to
um,
say some underlying fundamentals change over time. I mean,
yeah,
looking back, but that's also partly reflected in the risk. If you take a look, you can see where stuff starts to change. Monetary policy, some sort of bubbles that have so far only happened once, but are sort of taken into consideration. Yeah. So it'll be a very different model, also investing wise. But
yeah,
that's given considering it just pretty much always goes up over time. It's an inflation savings account, right?
yeah. Very much like that. And one thing that we noticed during testing, which was very interesting, which for the Bitcoin and ETH model, we obviously had diminishing returns and diminishing volatility, right? But here it was sort of the opposite, not very pronounced at all, but it appears as if the stock market has slightly increasing volatility. And, you could hypothesize day and night about why that is, but one thing I believe has a big impact is bot trading, robots. Basically, ever since the 2000s, which is where we observed a bigger increase in volatility compared to like the 50s and 60s. We used to have a lot more bots, right? I don't know how much of the volume bots and robots make up. I guess we can look it up, but
Probably
the
most of it.
majority of trading, um, yeah, yeah. So 60, 75% of overall trading, at least in the U.S. But yeah, so obviously when these huge drops occur, those are magnified by algorithmic trading, and we know that, and we could see signs of that in the data as well, which was a bit interesting. It's not necessarily accounted for the way it is in Bitcoin and ETH, but we know it's there.
Yeah. I think it's a good point to go into what actually goes into the risk model. You'd probably be surprised. So bot trading certainly isn't one of it. There's lots of stuff people usually look at when trying to model financial risk, especially macroeconomics with indices such as the S&P. Lots of people looking at M2, looking at inflation data. We do take that into consideration.
Yeah, of course, those are all the natural factors to begin to look at, and what everyone sort of expects. You look at inflation rates, money supply, velocity of money, employment rates, consumer confidence indexes, stuff like that, right? And at least we were surprised to see that it has less of an effect than you think, at least modeling these sort of things that we model, right? Which is present risk. And you could, of course, argue, well, they're lagging indicators and whatnot, but you'd still expect them to have perhaps more of an effect on the risk in this case than it actually turned out to have. So that's probably also interesting for you guys to know. It is taken into consideration, but keep in mind the model does what the model does. We can't force it to attribute weight to things that it doesn't want to, basically. Other stuff that goes into it, obviously a lot of price-based metrics, but you already know that from the other models. Volatility is, of course, in there. What else? It's a lot, basically.
It was a lot we took a look at. I mean, I remember building Bitcoin. The initial Bitcoin model took us a lot longer even to build. However, that was without any sort of routine, lots of learning. We thought applying all that we've learned over the years when modeling risk would really help us out here. And I guess it did to some point, but it was interesting to see how difficult to some extent it was to build this. Sometimes finding some indicators to build into the model felt hard to do. I wonder if it's because of the amount of time and also sort of different market fundamentals.
Yeah, and speaking of time, that is one of the things that actually had a bigger impact than we thought. So time is a significant input factor into this model, more so than it is into our other models, which makes sense, I think, considering it is a stock index and we are talking about decades and decades of data. It becomes, I think, slightly easier to derive useful information from time itself, which is what we have done. Yeah.
So I guess, I mean, we're also sort of surprised with the results. I guess, especially when it comes to dynamic DCA and this index. So we know that dynamic DCA works really well when you look at assets that are emerging, have strong volatility, but sort of not a given path, but you're able to model them as growth assets. Whereas the SPX really, it's a lot more complex. And since it goes up most of the time, it's much harder to even think about phases where you are not actively investing. So when using our approach and outperforming DCA, it's not so much about, or well, to some extent, of course, you are outperforming DCA, but it's not as extreme as you would think it is if you are well accustomed to looking at the BTC or ETH models, right? So we have tons of time between bottoms, and sometimes we don't really bottom out as much as we did in, let's say, the financial crisis or the housing crisis. So you have to adapt for that, and you will need a different strategy when investing with this model.
Yeah, I was just going to say the same. Generally, buying into the stock market, especially if you're buying into something like an index fund, it's a good idea to just generally keep buying. And that is sort of the finding that we had as well from building this model. So you will have to adapt your dynamic DCA strategies to some extent. Yeah, even if it's sort of perhaps tempting to take profits in high risk areas, you would just have to. It goes back to what I said, like it will generalize quite well. So if you're used to seeing the historical risk of the Bitcoin model and ETH model, take that into consideration coming over into this one, that high risk in the SP 500 is not like super high. Like it's not the end of the world buying into a high risk area of the S&P 500. It's generally just a lot safer and you're just looking at a lot less downside for higher levels of risk. So good thing to keep in mind.
Yeah, pretty much. If you are looking at current risk, it's at 67, 68. We are at 5.1K. Historically, I mean, with Bitcoin, you would say, all right, we're getting into sort of high risk territory. For the SPX, this is still a point where you are sort of safely investing. There's a high chance at 60 risk that you are probably not going to enter lower, at least for a very long time. And sometimes there is no point where you get in lower. I guess we'd really encourage to use the strategy builder at this point, test all of your strategies. You're open to only backtest the last 20, 25 years. Especially if you think monetary policy changes do affect markets to some extent. I mean, as Axel pointed out, markets have become more volatile instead of less, which is completely opposite of emerging assets or growth assets.
Mm-hmm.
Really, it's up to you. But in general, something alike of the aggressive preset will probably do best over time, at least from a risk reward perspective.
Yeah. And of course, highly dependent on who you are, how long you intend to invest. Are you investing for your pension? Are you buying a house? How soon? Are you young? Are you old? All of that stuff. I just ran a aggressive strategy on the SPX in the strategy builder. And if you run this for the past 20 years, you can actually see how it would have executed a sell 3 times. So this is just another way of showing you that you might want to, or you should expect something different from this model. And you will have to use it as such. Another important thing to point out, I think many of you might think that, well, this is like super long term, this model, right? It goes back to 1955. It's weekly data. You would probably like something more short term, and we will supply a short term model. But the thing is, you have to start with long term models. You can't sort of build a short term risk model that goes from 0 to 100 that works in the short term. People go to use that, they ape in their funds at 0 risk. Price goes down a lot later, and you sort of, well, wasn't this 0 risk? Well, in the short term, yes. So it's much, much better to start with a model that is perhaps even too much long term, and you could work your way down from there. From here, we will do the same with other assets, other coins. They will get their long-term model first, followed by perhaps something more short-term. There's a small chance we might push something intermediate short-term that we have experimented with or found to be interesting. Just something temporary for you guys to, you could even play around with it yourself.
Yeah, there are some interesting ideas, but I think we'll see about that.
Yeah, we'll see. We won't promise too much.
Yeah, better not.
Yeah. Last thing, the hypothetical risk price matrix. You want to mention that?
Right. So we mentioned time being a component, but of course, time in relation to other stuff. So when we do hypothetical calculation, it's not that simple. We have to sort of simulate where all of the single indicators might be headed, and then make sort of a calculated guess on where risk would be within the next given time frame. For this model, the way we approached it, that's not possible. So instead, we opted to show the top 10 SPX stocks, which I think sometimes is super interesting. Not everybody knows how concentrated the portfolio can get sometimes. I mean, you have FAN or XFAN in there just making up about, 20% of the SPX.
Yep.
Sort of interesting to see.
Yeah. And another thing to mention about the hypothetical risk matrix, it's still a VIP. We might change, or I guess we'll try to change portfolio to percentage change in price. Another thing to consider if you are following this model and you have holdings in the SPX is that, or not if you actually hold an index fund, but rather if you hold individual stocks that are part of the SPX and you would follow this model, you should consider that the SPX is not identical over time, right? The SPX is the top 500 companies. So companies move in and out of that. Just something to remember. It's not a constant portfolio of stocks, even though many of them are the same, especially the top ones, of course.
Is there anything else we wanted to cover? Next model?
Think so. Not for this one. Next model, I don't dare to say too much. I guess we'll do it in Telegram.
Fair point. All right. Thanks for watching. If there are any questions, of course, Axel mentioned it. We have a Telegram, but you can also mail us. So we're always here to answer questions if you need any help. We'll be happy to do so. Or the Telegram members in our community. I think they're quite informed too.
Yep, definitely.
Yeah. Thanks for watching.
All right.